Good morning, good afternoon, good evening. My name is Dr. Dabowski. Please welcome and let's take a look at the basics of financial accounting, which primarily stems from Chapter 1. One of the first things you want to consider is what is financial accounting. The primary thing that you can consider with regard to financial accounting is that it's got three connections. Number one are the investors, who need to make decisions about corporations, who therefore need to measure the activities of the corporations, and therefore the measurement of these activities as well as the communication of the information are all done and taken care of by the financial accountants. So the most important things you want to remember about financial accounting is that it involves measuring and communicating information about corporations. And the financial accountants are primarily responsible for that measuring of activities and communicating of the information. Another thing that you want to consider here is what is the basic accounting equation? As we learned in the metaphor that we're going to learn the rules and grammar of the accounting language, where assets are equal to liabilities and stockholders' equity. I want you to think of assets as resources. These are the things that you own. And then on the other side of the equilibrium, the equal sign, we have what we call the claims to those resources. The claims to the resources represent the liability claims, the creditors' claims, as well as the owner's claims, which we call stockholders' equity. So the basic accounting identity or basic accounting equation is expressed as follows. Another way of thinking about this equation is to say that the resources or the assets are the things that you own. The claims to the resources or the liabilities are what you owe against what you own. And then finally the resources or the claims to the resources include also stockholders' equity claims, which are known as the residuals for the owners. If you subtract what you owe from what you own, that equals the residual for the owners. And this is what we refer to as the basic model of business valuation. What are the key components of stockholders' equity? Well, we need to drill down on stockholders' equity. The three things that will go into stockholders' equity are going to be revenues, expenses, and dividends. Revenues minus expenses is known as net income or profits of the company. These represent the stockholders' claims of all profits because the owners of the company are rightfully entitled to the profits. The dividends are just what we call distributions to the owners, and it decreases their claims against the resources of the company. Now, how do accountants communicate? They communicate through four basic financial statements: the income statement, the statement of stockholders' equity, the balance sheet, the statement of cash flows. These are the four, what I call the big four financial statements. The income statement is simply where we measure our revenues minus our expenses to calculate net income. Net income is also owned or referred to as profits or earnings. Think of revenues as the sales of goods and services to the customers, and expenses are the costs of producing those revenues. Net income is just telling us, is the company successful in doing its business? The statement of stockholders' equity breaks stockholders' equity into common stock, which are the investment by the owners, and the retained earnings, which represents all net income less dividends over the entire life of the company. Underneath of the common stock, you can see that we reconcile the ending balance in common stock by taking the beginning balance of common stock, adding new issuances of common stock, which equals the ending balance of common stock. Under retained earnings, we start with our beginning balance of retained earnings. We add our net income, which is the revenues minus the expenses. Subtract dividends, which reduces retained earnings, which also reduces stockholders' equity, which equals the ending balance of our retained earnings. Again, the balance sheet reports only the resources and the claims to the resources. So that means just the assets, the liabilities, and the stockholders' equity. Think of assets. Now we're getting into the vocabulary of the accounting language. Assets are the resources owned by the company. Liabilities represent the claims or the creditors' claims to those resources. And the stockholders' equity represents any resources that are not claimed by the creditors. We then have the statement of cash flows, and I want you to think of a cash flow statement as something similar to a pig. What sound does a pig make? Correct. I heard oink, oink. Well, the statement of cash flow doesn't oink, it oifs. Operating, operating, investing, and financing. OIF, OIFs, operating, investing, and financing activities. Notice the positive numbers are inflows of cash, the negative numbers in parentheses are outflows of cash. All information on the statement of cash flows is reported as inflows and outflows. These are the links among the basic financial or the big four financial statements. This is very important. Please put an asterisk by this to study this later. Your income statement measures your net income, which is revenues minus expenses. This is what we call the articulation and how the financial statements are linked over time. The net income gets closed out into retained earnings, as you can follow the red arrow. Then the ending balances of your common stock and retained earnings accounts, which are your stockholders' equity accounts, comprise the ending balances of these accounts on your balance sheet. Follow the red arrows to the balance sheets. And then finally, the asset ending balance represents the cash, considering we have one asset, where it's a sum of the operating, the investing, and the financing cash flows, netting the inflows and the outflows together to produce our total cash flows. What we can see here is we can see three stock prices where we measure net income for Buckle, American Eagle, and Abercrombie. We can see that as net income is increasing over time or decreasing over time. We can see the percentage change over time. We can then look at the question of who will have the greatest increase in stock price. What we can see here is the company with the greatest or the cumulative increase in net income. The blue line has the highest growth in stock price. So the stock market likes net income accounting.